So let us start with a new chapter, portfolio management, also called as portfolio theories and asset pricing models. Okay, in CA syllabus, it is one chapter called as portfolio management. In CMA syllabus, they broken that into two parts: portfolio theories and asset pricing models. Two topics. In CA, they merged both of them into one area. Problems are same, concepts are same, every logic is absolutely the same. Very difficult chapter in your syllabus because of complicated formulae, mathematics and statistics involved inside, huge amount of logical knowledge required, great conceptual clarity is required, without which we can't even put pen on paper. Students are of two types with regard to this chapter. Number one, mugging up the formulae, doing the answers, which will be sufficient if paper comes easy. If paper is tough, literally they are gone. They can't even put pen on paper to write the answers. Chapter is very complicated because of more statistics and math involved in it. From the beginning onwards, if you listen, you will survive in this chapter. Every concept is equally important. There is no important, unimportant like that. Chapter will be easy if you understand statistics. I will be helping in that. I will not take any assumption that you learned these in any of the foundation. Statistics or math, I won't take as if that is my intention. Time value of money, that much time we need not spend. So therefore, I will never make an assumption that you know something. From the bare basics, what is the meaning of a mean, what is the meaning of correlation, covariance, everything I will explain in detail. Okay, next, please. Chapter is voluminous chapter, very big chapter in itself, takes a lot of time to complete. So therefore, as I said, every day from 6 o'clock till 8, we will spend time only on understanding this chapter called as portfolio theories. Okay, and this chapter will account for 20 to 25 marks in exams. Means you can understand the importance of this chapter in your final examinations as well. Listening everyone? So in the CA final exams, every attempt you take, minimum you will find 20 marks in PF, portfolio management. Sometimes it can soar even up to 30 marks in exam. Okay, so this is the weightage of this chapter, portfolio management. CMA exams also same. It will account for around 25 marks in examination. So with this, let us first write down the learning objectives of this chapter, portfolio theories and asset pricing models or portfolio management, and then we will start slowly one by one all the points. Okay, please keep the heading in your notes. Chapter is very important. I am telling you very clearly. Absolutely important chapter. Keep the heading. Portfolio theories and asset pricing models. Start as a new chapter. Portfolio theories, asset pricing models. No need, continue. Portfolio theories and asset. In the main workbook, what I give, it will be there anyway. Na? So no worry. Continue. Portfolio extra problems, if any, if you do later, no problem. We can write it somewhere else. Not a problem. Anyway, main workbook answers will be there. So continue. Keep the heading: portfolio theories, asset pricing models. Okay. In this chapter, we are going to do 70 problems. Study material has 22 problems. We are going to do 70 problems in this chapter. All the varieties of areas we are going to cover. I am talking with you everyone. Again, in the main question bank that will be released, in that I have kept totally 143 questions in this particular chapter called as portfolio theories. For additional practice, if you want, you can take it, or else no problem, you can do this and survive, not a problem. Shall we start with the chapter? Keep the heading: learning objectives. Learning objectives. Right on this. Second chapter, portfolio theories and asset pricing models. Learning objectives. Risk return profile of individual securities. Risk return profile of portfolio of securities. Understanding the terms mean, variance, and standard deviation. First three learning objectives completed. First three. Complete up to here. Next. Markowitz theory, all the 5 points have you written? Efficiency curve, efficiency frontier, utility theory, utility curve, and selection of best securities. Capital allocation line, capital market line. Next one, CAPM. Time and again I used to tell in class, CAPM concept will have lot of discussion in the chapter portfolio, and this is a time. So CAPM in depth from beginning till end we are going to analyze there. Right on this. Equilibrium theory. Not written. CAPM. Write on. Make it fast, please. Write on the balance. Equilibrium theory. Levered, unlevered beta. Equilibrium theory. Levered and unlevered beta. Unlevered beta. Characteristic market line. Characteristic market line. Sharpe's single index model. Sharpe's single index model. Arbitrage pricing theory. Others. Some miscellaneous concepts. Okay. Listen. These all put together will form part of one chapter called as portfolio management. Okay. Write down. If anyone didn't write, please copy down. Faculty and iPad. Second, nice. So see here. Hey, listen here. Listen. So equilibrium theory, levered, unlevered beta, characteristic market line, Sharpe's single index model, arbitrage pricing theory, and all other miscellaneous areas are there. We will do those. Totally, we will be doing around 70 problems in this particular, not around 70 problems we will do in this chapter called as portfolio. In CA exams, what they have done is they merged everything into one chapter called as portfolio management. In CMA, what they have done is up to CAPM, they named it portfolio management. From here, they named it as asset pricing models. Okay, but anyway, both of them are merged into one single chapter also in CMA. So syllabus is essentially 100% same portfolio. So therefore, important for anyone, either CNA, CMA, CSI, everywhere, main FM, this particular concept called as portfolio theories are there. So in this outset, let us first start with this particular concept, portfolio theories. First, why we require portfolio theories or portfolio management? Why we require? Listen, value of any asset is, please everyone, please see here. Value of any asset is present value of future cash flows discounted at a required rate. Discounted at a required rate. So the question arises, what is the discount rate? Discount rate can be KE, KD or KO. KO is not a separate calculation, just a merging of KE and KD over. So remove this. KD, very easy to calculate because I is known. Because see here, CA interval you might have done. KD equal to I into 1 minus T whole divided by NP. If it is irredeemable debenture. If it is redeemable, in CA final we call it YTM. YTM, yield to maturity. Okay. So yield to maturity means what? Post-mortem we will do in bond valuation already. Okay. So KD also called as a YTM. Formula is I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. We will get one answer. This is easy. So problem doesn't come with KD. Problem doesn't come with KO. Because KO is not a separate concept. KO is only just weighted averages of both KD and KE. So problem doesn't come with KO. Problem doesn't come with KD. Problem comes only with KE. Reason is, if I know the cash flows, I can calculate the KE. First thing, share market la cash flows are uncertain. Company may pay the dividend, may not pay the dividend. First tell me, how many cash flows will be there in a share? Share will give how many cash flows? How many times I said in share valuation chapter, first chapter, 2 cash flows will be there. Share gives 2 cash flow. Number 1, dividend. Number 2, sale price. How many cash flows share will give? Sale price depends on the market price prevailing. Dividend will be dependent on company declaring dividend. Problem is with both. Company need not pay dividend every year. Problem number 2, how much will be the market price after 1 year? I don't know. What you know then? Nothing I know. From nothing we need to generate something. That something happens to be KE. For that we need to write a theory. Therefore, persons like Markowitz, who first derived the traditional portfolio theory, who developed, please sir, no cross talking please. Person who has developed this Markowitz theory using utility curves and utility concept and brought out capital allocation line, Tobin, capital market line and CAPM, Sharp. After that Ross, arbitrage pricing theory, whatever the names I said now. Okay, Sharp single index model ki Sharp, name lone very clear. So, Markowitz, Tobin, Sharp, Ross, these are the 4 persons who are involved in the subject called as portfolio theories. All the 4 persons have got Nobel. Number 1, first got to Markowitz. After that it went for Tobin. Next it came for Sharp. Next it came for Ross. All the 4 persons have won the Nobel Award for the field of economics. Because, as I said already so many times, financial management is a branch of economics. Is a branch of economics. Economics ki there are 4 branches: micro, macro, statistics and finance. In that, what is the last branch? In that finance field of economics, they have won the Nobel. So, Carl Pearson, correlation coefficient, for that he got the Nobel. Like that, so many great people are there who have served for the field of economics. In economics, finance, in economics, micro, in economics, macro, in economics, statistics. All these are the branches of economics. Isn't it? Such a big branch economics is. In that, most relevant topic of economics is portfolio. Simply to tell, during the course of understanding this portfolio theories, we will get a doubt whether I am learning FM or I am learning economics. You will get a doubt because lot of demand, supply, equilibrium, all these concepts will come. If you are allergic towards economics, you will start loving economics after the chapter. That's a guarantee. You take my word. If you are allergic towards economics, if you are allergic towards statistics, by the end of this chapter, you will start loving them. You wanted to learn more. Diminishing marginal utility will not apply for this. Okay. So, at some point of time, you will feel that diminishing marginality will not apply. As and when more portfolio theories you read, more satisfaction will come. There is some more problems we have to do. So, such a good theory, such a good concept kept in the syllabus, we are fortunate enough at least to learn those. Number 1, why portfolio theories chapter? Value of any asset is present value of future cash flows discounted at a required rate. Discounted at a required rate means what is that required rate? KE. If it is a share. If it is a share, what we have to calculate? KE. How to calculate KE? Doubt. Don't tell CAPM. That CAPM model we have to derive now. So how that idea came? RF plus beta into RM minus RF. What is the concept behind that? That we are going to analyze now. Listening. That means we have seen sequel. Now we are seeing the prequel. So you already know what has happened in CAPM. But how CAPM has come? Now we are going to learn. In other chapters, what we learned already, or in the share valuation, already RF plus beta into RM minus RF. Sequel, you already introduced a character. But what this character used to do in flashback? We don't know. That flashback will be revealed in this chapter, portfolio theories. How that CAPM started. Listening? That's what we are going to analyze. So why KE should be RF plus beta into RM minus RF? What is RF? What is beta? What is RM? What is RM minus RF? What is beta into RM minus RF? Everything we are going to analyze now. Long discussion will be there. You should be patiently listening to the concept. First fine-tuned to the statistics. I will make you to do that. But before going into that, what is the value of any asset? Discounted at a required rate. Discounted at a required rate. What is the required rate? KE. How to calculate KE? We are going to see now. But question arises, why to calculate KE? Why KE is required? KE is required for two reasons. Number one, it is the discount rate for valuing the share. Till now, share valuation has so many problems we have done. Na? First column, second column, year, cash flow, PV at the rate of KE. To value the share, what is required? KE is required. Reason number one. That means unless and until you have a KE, you can't value the share. Number one. Reason number one, why we need KE. Second reason, project evaluation. What evaluation? I will give you a question, answer to this. You are all the equity shareholders. I took money from you. I am investing in a project. You all are expecting 14% as KE. Now I should invest in such a place which gives a KER of 14 or more than 14. That means to know that I should get more than 14 is known only if I know that 14 first. I should get more than? How you know that more than 14? Because the 14 is known. To compare R with KE, first what should be known? KE should be known. So for project evaluation, KE is required. So for two reasons. Number one, KE is the discount rate to discount the dividends and to calculate the value of a share. Some people are not in this world. Please come back properly. Shall we continue? I repeat, why KE is required? It is a discounting rate. For discounting which cash flows? Dividends cash flow. To arrive at what price? Share price. So to value a share, discounting factor is KE. Further KE is required. Second reason, to evaluate a project. Project will be evaluated on the basis of what and what? R and KE. R is less than KE. Project should be taken or not to be taken? R equal to KE. May or may not. R less than KE. R less than or greater than KE. Accept. That means to tell R less than or greater than or equal to, first what you should know? KE should be known. So further KE is required. But how to calculate KE? Using the portfolio theories. Understood the need for portfolio theories, everyone? Answer. This KE will be calculated using so many theories, namely the following. Read. What is the first one? Markowitz theory, utility theory. Now like this you need to read. Start. Utility theory. Capital allocation line, capital market line. CAPM, arbitrage pricing theory. Characteristic market line, Sharpe's single index model. How many theories are there? 8. 8 theories in this chapter. Listening, these 8 theories forms the chapter. So these are all the various ways which are used to calculate the KE. In that, CAPM became worldwide popular. In all these, CAPM became worldwide popular. Okay, most acclaimed method of valuing the discounting rate is CAPM model of KE. Why? We will see that. Up to here, everyone understood the concept clearly? Okay, now tell me, read the points. Value of any asset is Future cash flows discounted at a required rate. So what is the value of a share? Present value of future dividends discounted at a required rate. Next. The impact of dividends on share price is already analyzed in the previous chapter. Share valuation chapter we have done or not? So in this chapter we are going to analyze the discount rates. Fair value of a share. Share is affected by three factors. Factor 1, life. Factor 2, factor 3, if you remember, I said a triangle. Triangle, three things are there. Life, cash flow, discount rate. Life anyway, share life is perpetual. Cash flows are already analyzed in the last chapter, dividends. Share valuation we have done the previous one. In the share valuation, everywhere dividends are there with discounted dividends calculated. Gordon model, constant dividend growth. Walter model, only dividend without growth. Dividend discount model, 2 stages, 3 stages we have done. Correct? All these are discussing about what? Dividends, how cash flows are affecting the share price. Their discount factor is not important. What is important for us? Cash flows are important. In this chapter, what we are going to analyze? KE, discounting factor. Read. Factor 1 is life. Assumed as perpetual. No separate concept for that. Factor 2, cash flows, dividends. Already analyzed in the first chapter. Share valuation. Next, factor 3, discount rate. Cost of equity, KE, will be thoroughly analyzed in this chapter. What are the various models through which we are going to calculate KE? Markowitz theory, utility theory, capital allocation line, capital market line, CAPM, arbitrage pricing theory, characteristic market line, Sharpe's single index model. All these are various ways of calculating one amount called as KE. Up to here, everyone understood? Understood? This is what I wanted to tell in the first part. First, you do one thing. First, need for portfolio theories, everyone need to know. Write down this. From thereafter, theory you need not write. Questions and answers we need to copy. Questions I will show. Answer anyway we have to do. 70 questions plus 70 we have to do in the class. Okay. 1 minute. Write down. Need for portfolio theories. So make it fast, please. So this entire chapter focuses only on one concept: discount rate discovery. That's all. KE discovery. How to discover the KE out of the numbers given is the entire idea of this particular chapter. Share valuation will not be there. KE valuation will be there. Once we complete portfolio theories, then only you can understand futures and options, because they are completely linked to portfolios. Completed all the three factors. Write on the balance. Completed writing. Okay. See here now. So the entire chapter focuses on calculating KE. Listen, there are various methods of calculating the KE, but what is the modus operandi? Means the whole idea behind calculation of KE is the concept of risk. Let me explain the point clearly. Completed writing, everyone in the class? Now listen. Please listen. KE is return expected by the shareholder. KE is the return expected by the shareholder from the shares. From the shares he invested, what is the return you are expecting? We call it as a KE. Minimum return expected by the shareholder. Minimum return the company must pay the shareholder. We call it in the form of KE. KE is a cost to company, return to the investor. Here everyone understood clearly? Now listen, focus on the point. Therefore what happened? KE is a return to the shareholder. It is a cost to the company. Till now, whatever the models you have seen, I will show you an example for you to atone the concept of risk and returns. Okay. See here. Till now, no cross talking in this chapter, please. Shall we? KE equal to D1 by P naught plus G. KE, not P naught. KE equal to D1 by P naught plus G. Now answer my question. What is P naught? Market price investment technically. It is the investment. D1 is return. G is written as P1 minus P naught whole divided by P naught. In the first class as also I said this. So technically this is the capital appreciation. This is the dividend yield. This is called as a dividend yield. This is called as a capital yield or capital appreciation. Both together is the total yield. In this formula, KE equal to D1 by P naught plus G, we analyzed KE as a return angle. How much investment, how much return, how much investment, how much capital appreciation return. Means we are analyzing KE from return angle, risk angle. Answer, return angle we are calculating it. From now, in this entire chapter, we will see KE from a different angle. Means we don't see KE as a return, we will see from the angle of a risk. Means this much risk I am taking, how much return I should ask. That's how we are going to analyze. More scientific way of understanding the returns. Listening? If you observe here clearly, please tell me what is P naught? Answer. Investment means market price after 1 year today now. Answer. This is already happened. From the happened information you are gathering the returns. I don't want like that. I wanted to know what will happen in the future. Bhavishyavani I want. For that I need to calculate KE. So till now we calculated KE as a return calculation. From now we are not going to see KE that way. We are going to calculate KE from the angle of a risk. Means what is the risk in the investment? First know about it. If you are taking this much risk, how much KE you should ask? Like that we are going to calculate. Till now? On what basis we calculated KE? Return basis we calculated. From now, risk basis we are going to calculate. If you are taking this much risk, how much return I should ask for that? Listening? Now tell me, what is risk? Death is risk? We are not doing that risk. We are doing which risk? Financial risk. Financial risk means what? Financial risk means uncertainty. Means, listen, RBI bonds, riskiya, not riskiya. SBI FD, riskiya, not riskiya. Why they are not risky? Because payment is certain. If I deposited my money in 6% FD, 1 lakh rupee, first year I will get 6,000, second year I will get 6,000, third, fourth, fifth I will get 6,000. Correct? I will not get more than 6,000. I will not get less than 6,000. Guarantee I will get that 6,000. Riskiya, not riskiya. But if I invest in Infosys, TCS, Reliance, etc., I can guarantee that return. Cannot guarantee. 1 year I may get higher return. 1 year I may get lower return. 1 year I may not get a return at all. I may get negative returns also. Listening. Dividend may not be negative, but P1 minus P naught can be negative. I purchased at 100. 1 year after it went to 80. 80 is the P1. P naught is the 100. 80 minus 100 is minus 20. My return is a negative. Listening? So, if the bond or a share is risk free, then no problem. But if it is risky represents uncertainty. So listen carefully to my point. In this entire chapter, risk represents what? Uncertainty. I repeat one more time. In this entire chapter, risk represents what? Uncertainty of getting the expected returns is called as a risk. Here, to calculate KE, first we need to calculate risk. How to calculate the risk? That is what beta calculations came. Beta is also called as a measure of risk. Okay. So all those things we are going to analyze. One more time I am telling. In this chapter, portfolio management, we are going to analyze return alone or risk and return. Answer. First we need to analyze. From that we need to analyze. For this amount of return, how much risk I can take? No fool will see. For this amount of risk, how much return I should have? That's how we need to calculate. So first we need to understand what? That's why in this chapter, systematic risk, unsystematic risk, all these concepts came. Listening everyone? So very complicated economic concepts will be there. So please concentrate properly. Shall we start with the chapter now? We will take one question and try to analyze them. See question number 1 on the screen. Problem number 1 and 2 are the targets for today. I am not going to put any great targets for today. Today's session we are going to complete 1 and 2. If you complete that, big gift. For you, I am not talking about that. We will complete that concept. That much time it will take to understand. First point number 1. Again and again in my entire classes I tell the same. We are not going to apply some bunch of formulas and answers. First we have to interpret the numbers, try to understand and then solve the answer. Listening? See the screen. Following is the return of two securities for the past 5 years. Calculate for each the expected return and expected risk. Year 1, 2, 3, 4 and 5. Security X returns, percentages they have given. Security Y returns, percentages they have given. This is the information given. From this information they are asking us to calculate the expected return, expected risk. See that first. Okay. Why I am asking you to read the question? I am asking to read the question because I wanted to ask one question on the question only. But you are looking after somewhere, you are doing your own work. Read the question. I have a question on the question only. Okay. First one. Tell me, there are two securities. Security X and security Y. He is asking, calculate for each of the securities return and risk, or risk and return. Okay, we are not going to calculate for this risk how much return we need to calculate. No, just he is asking us to calculate expected return, expected risk. So why he is using the word expected? Because nothing is guaranteed in stock markets. Everything is only a expectation. Your expectation will always be right, may also be wrong. That wrong in expectation is a risk. I will expect some amount. That may happen, may not happen. More or less the same, anything can happen. That itself is uncertain. Uncertainty results in risk. So listen carefully now. What is this info given? First let us decode this particular question given. They have given 5 years info, past info, 5 years, past 5 years information they have given. They are telling that on the basis of the past 5 years, assume that they are going to happen also in the future. Estimate the return, estimate the risk. Not understood. I will repeat. See here. How many years information was given? On the basis of the past. Okay. Predict the future. If past is going to recur in the future, assuming that past trend will continue in the future, calculate the expected return, expected risk. Sorry. Like this, if I tell, people may understand, may not understand. I will give an example. Listen. There is a student. FR, SFM, Law and audit. 4 subjects are there. Say example. He wrote exam and came. I said, how many marks you are expecting? How many marks you are, please. No cross talking. I said, don't make any comments on the questions. Please. We don't have that much time. So please listen. He said that in CFR, I will be getting 60. In SFM, I will be getting 70. In law, I will be getting 60. Audit, I will be getting 60. Like that. Some amount he said. Or he said that I will get 50. Some expected amounts he said. Listening. Now tell me 60, 70, 60 and 50. Sorry, I will write 65. No amount who should match with any other number. So 60, 70, 65 and 50. This is what he said. Listening, everyone? Or in the recent test conducted in the institute here, in the private institutes, they conducted one grand final exam. In the final exam, he got these marks. Okay? 60, 70, 65 and 50, he got the marks. Actually, he got this in a test conducted by a private institute, not by ICAl. Question papers came very tough. And they have written, and he got these marks and he qualified there. Listening? On the basis of this, estimate how much he will get in the final examinations conducted by ICAl. A person asks you. Then you can't tell that he will get 70 or he will get 50. Whenever a person asks us to estimate, we will always estimate in averages. Means technically we don't tell that he will get 70 in a highest extreme. We don't tell he will get very less in a lowest extreme of 50. We will tell that he may get an average mark. So I will tell this way. See here. Private institute conducted exam on SFM or AFM, whatever the case may be. They conducted one examination in a private institute. 4 exams they conducted. First test, second test, third test and fourth test. First test, all papers are moderate and moderately hard. Not so much hard, not so much easy. Moderately like an exams they came. First test number 1, he got 70. Next test he got 80. Next test he got 50. Next test he got 60. All the 4 belong to one subject. These are all to be happened in future, already happened in the past. Like this. Already happened returns, already happened exams, already happened returns, already happened marks. Listening, I asked you, how much you will expect? What happens in reality, God should know. How much? Please see the screen, everyone. How much will you expect from this particular student to get in the final exam conducted by the institute? Means a CR, CMA exam, whatever the case may be. In the final examination conducted by ICAl, how many marks you expect from this student on the basis of his past performance? You will tell 80. You will tell 80. Why you will not tell 80? 80 is the highest extreme. You will tell 45. Why you will not tell he got 45, 50 once? That means human beings tend to run towards the averages. I will not tell extremely 80. I will not expect extremely 50. Lowest extreme I don't expect. Highest extreme also I don't expect. I will expect in average. What I can tell? 70 plus 80 plus 50 plus 60 divided by 4. I will tell that averagely he may get 65 marks in final exam. Listening, everyone in the class. How much you can expect? 65. 65 is guaranteed average. Guaranteed average. Now tell me, what is the average? 65. Now please tell me one more time. How many marks he got in the past exams? 70, 80, 50, 60. Highest extreme, how much he got? Lowest extreme, how much you got? You expect in extremes, You expect in averages. Expect in Average. What is average? Now tell me. You are expecting 65 to come in the final examination. This is guaranteed 65. Estimated 65. Expected. Absolute. Therefore, your expectation will be true. May not be true. There may be a deviation or not. The deviation we call standard deviation. Deviation we call as a standard deviation. Deviation means possibility of non-occurrence of expected result. Repeat the statement. Possibility of or percentage of non-occurrence of expected result. Tell me, how much you are expecting to come? 70 or 80 years, some people are not in this world. Please come back. 70 or 80 or 50 or 60 or 65. That is guaranteed approximate. Average absolute. There is a deviation, no deviation. Now answer. Average you are expecting how much? After 65 is not there in any of the 4 marks. He didn't get 65 any time. But still you are expecting 65. Because 65 is a average. People may throw stones against averages, but for us, God is average in FM. Listening, people may tell average is not correct estimate, but for FM, all theories in the worldwide, they expect only average. So how can you prove that FM estimates always averages? Shall I tell you why? Standard normal distribution table, the peak point in the middle is average. Bell-shaped curve will be there. Normal table distribution, what is the midpoint? 1 second, this is gone. One second, he's there. Where he will be? It came. So okay, see here. Tell me, how much he got in the first exam? Sir, peacefully first learn the basics properly. Remaining you will understand easily. Basics life you do overaction, gone. I am telling you very, very clearly. Fasak. See there. How much he got in the past exam? 70, 80, 50 and 60. Those are all already happened, yet to happen. Already happened, one extreme is there, one lowest extreme is also there. You don't expect in extremes. You expect always in average. Average came to how much? This is actual average. Answer. That actual itself is having a deviation from this average. Okay. Now we will calculate the deviation. 70 minus 65, 5. 80 minus 65, 15. 50 minus 65, 60 minus 65. Like this there will be a deviation. Deviation means chance of non-occurrence. The width of non-occurrence. Tell me, you are expecting 65. Actual information 70, 80, 50, 60 you have taken. Total them divided by 4. You got the answer as 65. Correct? That 65 is having a deviation from the actual information you have taken. Actual information is 70 you have taken. That 70 is having a deviation with this 65. 65 is guaranteed average. I asked this question 10 times now. 65 is average guaranteed. Can happen, may not also happen. May not also happen. There is uncertainty or no uncertainty. Uncertainty. Calculating that uncertainty itself is called as a standard deviation, also called as a risk of that instrument. Shall we apply the same and calculate that for that? Let's do together. Keep the heading calculation of return and risk of security X. Write down. Question number 1. Calculation of return and risk of security X. Okay. Let us first see the info given. See here. Question number 1. Here 1, 2, 3, 4, 5 already happened here, sir. Yet to happen here, sir. Security X. Let us write down. Here 1, 2, 3, 4 and 5. For which security you are writing the answer? Always remember, when a security name is given, write that name in the column. Don't write return, write X. X denotes the returns of that security. Okay? And tell me, what is the numbers given? 6.6, 5.6, 6.6, 5.6, minus 9, 12.6 and 14. Okay, tell me, this security in the past has given returns at what percentages? Tell me. 6.6. Sir, I came to you and I said, security X has given 6.6, 5.6, minus 9, 12.6 and 14 in the last 5 years. How much you will expect in future? I ask you a question. What you will tell? You will tell 14, eh? You will tell minus 9, eh? Why you will not tell both? Both happened really. But both happened, but they happened in normal circumstances, extreme cases. 14 is the positive extreme. Minus 9 is a negative extreme. Don't expect in extremes, expect in averages. So first we need to calculate the average return over a period of 5 years. Total them. This is called as sigma X. 29.9, 29.8. Okay. Sigma X. So this sigma is total. This sigma is standard deviation. Over. What is 29.8? Average. Total of all the returns. We have to calculate total return, average return. X bar equal to sigma X by N. Sigma X by N, average over a period of 5 years. 29.8 divided by 5. 29.8 divided by 5 is 5.96%. 5.96%. A person asks you, how much you will expect from this security in future? You will say 6.6 or 5.6 or minus 9 or 12.6 or 14 or 29.8% or 5.96%. 5.96% is what? Guarantee it will happen or may not happen. How can you prove that it may not happen? Actual with none of them this is matching. First one actual. This is 5.96, not matching. That means from actual information you calculated 5.96, but that 5.96 is not matching with any of the actual information. That means it is having a deviation with actual, not having a deviation. Having a deviation. That we are going to calculate now. Shall we do? Write down. X minus X bar. This is called as deviation. Calculate. 6.6 minus 5.96, 0.64. 5.6 minus 5.96, minus 0.36. Minus 9 minus 5.96, 14.96. Minus 12.6 minus 5.96, 6.64. 14 minus 5.96, 8.04. Okay. Tell me, what is x minus x bar? Everyone, what is x minus x bar? Deviation means what? What is the deviation meaning? What is the meaning of deviation? Meaning of deviation, one second. Meaning of deviation means, the meaning of deviation actually in statistics is the difference between actual and the average. The difference between? I will tell this way. Sachin Tendulkar's average strike rate is 58. Means every match he scored 58. Run rate 58 I tell. Sachin Tendulkar's run rate is 58. Every match he scored 58. Some matches he scored 200 also. Some matches he was duck out as well. Then what is 58? Average. Now you understood the point clearly. Those are all averages. Say one player will be at there 55, 60, 48, 49. If you tell na, throughout his career, average every match he scored 58. One match la duck out, one match la 200, 170, 180. Like that he scored dashing more than hundreds. Like that he also scored within hundreds, within 50, within 10, 0 also he was duck out for around 20-25 times. From this, what is the logic you need to understand? 58 is an average run rate. Likewise, average is guaranteed. 58 really happened every match. It is only average. Likewise, this is also average 5.96. From the actual, if you see, this may not be real. Listening everyone? But worldwide run rate is calculated as a average only. We are believing in that. Average always gives us overall performance. Average gives us the overall performance of a person or a stock or anything. That's why averages became popular. Clear everyone? From average, one can assess the performance of a person. If the average is 58, means what? Around 60. 60 means what? Every match he came, he played for 60 runs, which is very difficult for any player in the international cricket. Every match he came, he scored 60. That doesn't mean that really he scored only 60 exactly. And 60 runs after I am retiring. No. Some matches I may score more than 100. Some matches I may score 20-30 as well. On an average, my strike rate is 60. Likewise, I may give 6.6, 5.6, minus 9. Sometimes I may give also 14. But on an average, what is my performance? 5.9, so almost 6 here also. This is my performance. But the performance is that average what you calculated is a real, is it different from the actual? That we are going to analyze now. Everyone understood the logic clearly or not? Everyone in the class? X minus x bar means deviation, difference. Deviation means what? Difference of actual from the average. Difference of the actual from the average. This is a deviation. When I say change, change means what? Mark. Difference. Difference ki positive negatives will not be there. Change is a change, that's all. You should not attach any kind of symbols to that. To avoid the symbol, we are squaring it. To avoid the symbol, what we are going to do? Answer, square it. Really square should be made, No, therefore to neutralize we will use square root again. So, unnecessarily use the square, that will be neutralized using the square root. That's why standard deviation have square root to that. That's how the mathematical logics came. That's why in so many countries, square root will not be used. They will use it as 1 by half, 1 by 2. That means root of 16, they will use 60 power 1 by 2. Like this they will use. 2, 1 by 2, both will get cancelled. Square root 1 by 2 means that both will get cancelled. To give that neutralizing effect, they will first square to remove the symbol. But they should square, should not square, should not square. To neutralize that, what they will use? Square root. That's how mathematically this is proven. Listening now, why they will square and use the square root? This is the reason. Tell me. Up to here, everyone copied the notes? Please do along with me and tell me the answers. X minus x bar whole square. Why we are doing square? To do square root. To do what? To remove the symbol. Square it. 0.5 4096. 0.1296. 14.96 square. 223.8016. 6.64 square. 44.0896. 8.04 square. 64.6416. Total this. Don't total deviations. It will become 0. Deviations square you can total. 333.0. This is sigma x minus x bar the whole square. Now again squares also I need to explain you. Don't write like this. X minus x bar whole square. Square is not for x bar. Square is for the x minus x bar. X minus x bar the whole square. It's not x minus x bar square. It is x minus x bar the whole square. Hello, done with answer everyone? Now, standard deviation equal to, write down, root of sigma x minus x bar the whole square divided by n. Root of 333.072 whole divided by 5. Don't square that 333.72 again. Math how will 333.072 square చేస్తే అంతే బొమ్మ ఏముండదు రిటర్న్ 1000% వస్తుంది. So don't do that. It's already information given in squares. Don't square this again. 333.072 divided by 5. For that apply square root. How much? 8.16%. 8.16%. Okay? And now I have one question answer. What is the meaning of 8.16? What is the 8.16 called as? It is the expected deviation. Again, this is also average because we are dividing it by what? N. So this is expected deviation. Listen, I will explain this way. What is the average return you are expecting? What is the average return you are expecting? See the screen and tell what is the average return you are expecting. That will definitely happen, may or may not happen. What is the chance that it may not happen? 8.16% means my 5.96 can go up to 14. My 5.96 may go even to negative. Average is 5.96. Sachin's run rate average is 60. Sometimes it can go up to 0. Sometimes it can go also up to 200. So, instead of telling this much information, just about a stock I will tell like this. Mean is, mean, M-E-A-N. This is called as a mean. This is called as standard deviation. Listen, if I tell to an investor like this, shall we? Average the security will give 6% with a deviation of 8.16. Enough. You need not tell all this information now. He will only tell, okay, average 6, deviation 8. Means what? Deviation means it can move left hand side, it can move right hand side as well. That's why normal distribution, 3 standard deviation to the left, 3 standard deviation to the right. Both are deviations. One is a positive deviation, another one is a negative deviation. Means if I tell this way, this stock will give an average return of 5.96 with a deviation of 8.16. Means what you have to understand? Average of 5.96 will give here. But sometimes it can go to the positive extreme by adding 8.16. Sometimes it can also go back by a negative extreme of 8.16. Okay, that means you will understand. Okay, that means my return can go as big as 14. My return can go as low as -4, -5 as well. Then the person will decide whether to invest or not to invest in the stock. Listening or not? So tell me how to interpret these numbers. Sir, but we don't do. Understand and do. Tell me what is the average return? What do you mean by 5.96? What do you mean by 5.96? Average return. That is guaranteed a deviation. How much deviation is there? 8.16 is a deviation. Means what? Deviation around the mean. Okay? Means 5.96 can go to 7, 8, 9, 10, 11, 12, 13, 14 also it can go. Or 5.96 can go to 3, 2, 1, 0, minus 1, minus 2 also it can go. Who should decide whether to invest or not to invest? Investor. That means instead of giving him 5 years information, x minus x bar, the whole square, instead of giving all this, tell 2 informations about a stock. First, average it will give 5.96 with a deviation of 8.16. You decide whether to invest or not to invest. Over game. Listening or not, everyone? Average CA Institute will give percentage of 15 for CA final with a deviation of 7. I said. Means how to understand this? Sometimes 15 can go up to 22, 23 like last attempt. Sometimes it can go as low as 6-7% also. Decide whether to come or not to come. Over. Now did you understand the importance of average and deviations? Instead of giving so much information, give 2 informations only. One mean and the one standard deviation. That's why mean and standard deviation has become the heart and core of statistics. Hopefully everyone understood the logic clearly. Like that, analyze stocks as well. This is how we analyze. This is the point. Now tell me, mean standard deviation will be always expressed in what? Rupees, percentage of liters, kgs. In what way you should express that? Answer wrong as per the information. If it is in liters, answer will come in percentage. Information is in kgs. Okay? Answer will come in percentage. Deviation comes in percentages. Here securities are information is in percentage. So always the mean standard deviation will be expressed in terms of the population. Population means the information. Information is in kgs. Answers will be in kgs. Information cases, answer will be in letters. So same. So don't mug up. Adi mug up ante. Just now I told you, this is called as batti. Standard deviation, percentage. Mean, percentage. If I give the information in rupees, percentage. Why? Ante adante ala batti kottali. So don't mug up the concepts here. Percentage is not always true. In this question, information is in percentage, answers came in percentage. Okay. Next, this is for which security? We have to do like this also for which security? Let's do together. Now you will interpret the answer. Start doing. Security Y. Here Y minus Y bar, stop talking. Y minus Y bar the whole square. 1, 2, 3, 4 and 5. Take the info. 24.5 minus 5.9 19.9 minus 7.8 14.8. Tell me, I gave this information to you about the stock. I said you expect the future. You will expect 24.5 or you will expect minus 7.8. What you will expect? Average. Total first. Sigma Y. 24.5 minus 5.9 plus 19.9 minus 7.8 plus 14.8 45.50. Y bar equal to sigma Y by n. 45.5 divided by 5, 9.1%. There is a deviation, no deviation, full deviation. Actually somewhere average is somewhere. 24.5 minus 9.1, 15.4 positive. 5.9 minus 5.9 minus 9.1 minus 15. 19.9 minus 9.1 10.8 minus 7.8 minus 9.1 minus 16.9. 14.8 minus 9.1 5.7. Don't total them, answer will be 0. ये చేసేది ఓవర్ క్యాలిక్యులేషన్స్. 237.16. 15 square 225. 10.8 square 116.64. 16.9 square 285.61. 5.7 square 32.49. 237.16 plus 220. 896.9. What is 896.9? Sigma y minus y bar the whole square. We want sigma y. Write the formula first. Root of sigma y minus y bar the whole square divided by n. That equal to 896.9 divided by 5 whole the root. 13.39 percentage. 13.39 percentage. From this, what you have to understand? This security on an average will give how much return? 9.1. But this is guaranteed deviated. How much it can go? It can go as long as 22, 23 sometimes. It can fall as bad as -4 to -3 as well. Okay. So this is how we need to analyze a stock. How many stocks we analyze now? 2 stocks. X, Y. Not yet completed. Answers over. Exam what he tested for 5 marks completed. But now we are going to make additional analysis on this. Up to here everyone had a full clarity. Yeah. Now tell me. Right now. Summary. Let us summarize both the securities. X, Y. Mean, standard deviation. Tell me, what is the mean of security X? Mean, average return of security X 5.96. Standard deviation 8.16. Security Y 9.1. 13.39 percentage. Tell me, which security you will prefer? Security X or security Y? Which one you will prefer? See the screen and tell. Which security you will prefer? Security X you will prefer or security Y you will prefer? Tell me. Preference time you will give X or Y? Both are good. Listen. I know what you will tell. Are difference between average and standard deviation in the first case is 2 or nearing 2. Here there is a huge gap between 9.1 and 13.39. This is one answer you will give. Or the risk is very high in security Y. Both are wrong answers. Shall I tell one point? High risk, high return. Low risk, low return. Who is giving high risk? Therefore they are giving high return. Who is giving low risk? Therefore they are giving low return. X is a low risk, low return giving security. Y is a high risk, high return giving security. Selection of any of these securities is entirely dependent on risk preferences of the investor. If you want to take high risk, you will go for Y. Low risk. So tell me, risk is very low in BCom. Salary is also very low. Risk is very high in professional courses like CA. Both these things. So risk is very high in professional courses, that I said very clearly. So risk is very high in professional courses. Therefore return is also very high. Now which will you choose? That's all. That is your choice. Further, don't blame that why you are not joining CS, CMA, CS. Some people will join only BCom and stop. Means what? They are coming under first category. They are taking low risk, they will get low return. You are taking high risk, you will get high returns. Answer over. It is entirely dependent on the mindset of the investor. Who wanted to take high risk, they will get high return. Who wanted to take low risk, they will get low returns. Yeah. So which is better means don't judge anything now. X is better, Y is bad, Y is better. Now if I change information, tell me. If I change information, 7.16% is the risk of security Y. Which will you prefer? See there? See the question and tell ya. So what is the standard deviation of what is the risk of security X? What is the risk of security X? 1.6. For that, what is the return they are giving? 5.9. Y is giving how much risk? Lesser risk than X, but it is giving higher return than X. Now, which one will you prefer? Everyone should go for Y only now, because it is giving lower risk, higher return. Understood the logic clearly? Yeah? So, therefore, this is the first point we need to understand. So, at the outset of understanding basics, when you see this, which is better? Y or X or Y? Both. Yeah. So, X, Y. Now tell me, in X and Y, if you take both, which is better? X or Y? Both are good. It depends on investor risk preferences. His risk appetite will decide which one to choose. I am a high risk taking Y. I am a low risk taker X. This is how we need to analyze the answer. Everyone understood? One last question. If there is a government security X only, you see, why you forget? See this. There is a government security RBI bond giving 5.96% return. Giving 5.96. Who is giving? Government security is giving 5.96% return. Like that of X. You will choose X or government bond. Again, I am asking, listen sir, first. X is giving how much return? Answer. Government bond is also giving how much? 5.9. Which one will you choose? Government bond or security X? Both are okay na? Answer. Why? Both are giving same return na? Government bond will give 5.96. It will give 5.96, 5.96, 5.96, 5.96 and 5.96. Total will be 5.96. Naral Gatipini. Into 5, how much? 29.8. Average is how much? Now tell me. Security X, what is the average? Security X, what is average? 5.9. Government bond, what is average? 5.96. Security X total 29.8. Government bond 29.8. Both are same. Hey. Both are same. Therefore, we can invest on both. In that So what we have to do? Average, if you calculate, tell me 5.96 minus 5.96. 5.96 minus 5.96. 0, 0, 0. Square to 0. 0, 0, 0, 0. Deviation will be 0. And the risk? No risk. Government bond will give no risk 5.96. Here you are taking a risk of 8.16 and then getting a return. Which one will you choose? From this, what you have to understand, don't just see returns and invest. Don't just see risk and invest. See both risk and returns and then invest in the stock is the moral of the story of this chapter. Everyone understood the idea behind portfolio theories. This is the idea of the chapter called as portfolio theories. This is the introduction completed to portfolio theories chapter. That's why I told you this particular topic is very complicated. Once you are streamlined and understand the concepts, I told you very clearly, you will enjoy the chapter portfolio management like anything, provided you are not allergic towards these concepts. I will make it as interesting as possible. First question, everyone thoroughly understood the concept clearly, yeah? How many securities are given in the question? One is another one. We analyzed X, we analyzed Y, calculated return of X, return of Y, standard deviation of X, standard deviation of Y. Every calculation is completed. But I didn't explain one small area in this. That is, how that 6.62, 5.6, minus 9, 12.6, 14 has come. That they didn't ask, but how they would have got. A question will arise or not. That also analyze and leave. I told you, na, 2 problems I said, 1 problem we completed. I know. Listen. See the screen once. Shall we? See that. Here, 0. Please don't talk. Listen. 0, 1, 2, 3. Okay. A person has invested today at 100. 1 year after, share price went to 105. 1 year after, share price came to 102. Next year, it came to 109. Dividend paid by the company. 0 here invested, no dividend is paid immediately. First year it paid a dividend of 2 rupee. Next year it don't pay any dividend. Next year it paid a dividend of 3 rupee. Okay, ba? So this is a scenario of my particular situation. Now I want to calculate return. Return is D1 plus P1 minus P0 whole divided by P0. Please help me with the numbers. First year anyway I don't need 0 here. First year tell me, what is the D1? 2 plus what is the P1? 105 minus P0? 100 whole divided by 100 into 100. Tell me, 2 plus 105 minus 100 whole divided by 100. How much percent? 7%. Please tell the next number now. What is the dividend? 0 plus 102 minus 105 whole divided by 105 into 100. 102 minus 105 whole divided by 105 into 100. How much? Minus 2.86%. Hello, correct? Next, 3 plus 109 minus 102 whole divided by 102 into 100. 3 plus 109 minus 102 whole divided by 102 into 100. How much? 8%. So tell me the final information. You tell me year 1, 2, 3. What is the returns I got? 7% minus 2.86, 9.8. Like this, they have got this information. Like this, they have calculated and given in the question. This is the prequel to the prequel. And how they would have got these numbers, like this, they might have calculated. Understood the idea behind the question now? Answer everyone. With this, I wanted to close for the today's session. Tomorrow's session, rigorously we will start doing the chapter portfolio. Now you can understand the importance of this chapter, depth of this chapter, how many concepts will be there. Like this only entire chapter will be. Very big chapter in our entire syllabus. So throughout our learning process, we will have every day a topic on portfolio chapter. Listening everyone in the class. So thank you very much. Meet you again in the next session.